Where are we now? We are on the class and series. So pardon me about that. The class and series is going to be all options having the same type, underlying strike price and expiration date. We're a little bit out of order on that, so I apologize because we haven't gotten to exercise or expiration date yet. The unit of trade, that's going to be the number of shares that exchange hands in the event of exercise or assignment. Our strike price is a little tricky. Now, on the surface, it's easy. And actually, I recorded a video yesterday talking about this. On the surface, the strike price, a lot of us use the definition that that is the per share price at which you have the right or the obligation to buy or sell the stock. And that's true, but that is assuming that we're talking standard options. So we've got a standard deliverable of 100 shares. We've got a standard multiplier of 100. If those are true, then yes, the strike price represents the per share price. I like to look at the strike price as maybe another phrase for it is the exercise price, because if I'm exercising a $50 option, I'm paying 50 times the multiplier, so I'm paying $5,000. And in return, I'm getting whatever that deliverable may be. It might be 100 shares of stock, it might be 50 shares of stock, what have you. So strike price or exercise price, they're kind of one and the same. But the idea of it for a standard contract, it's the per share price that you've got the right or the obligation to buy or sell that stock. And then the exercise or the expiration date is going to be the date upon which that right or obligation ceases to exist. All right, we good on those? All right, excellent. Let's, well, here's a question that I see that just came in from Jelvaner. How do you know which style you are buying or selling? Excellent question, thank you for that. Currently, all equities and all ETFs are American style. And the majority of indices, as a matter of fact, I think there's only one index that is American style, but all other index contracts are European, which is one of the reasons why institutional firms, hedge funds, banks, insurance companies, et cetera, one of the reasons why they typically do invest in index options is to take away that risk of assignment. If you can get assigned at any time for any reason, remember we talked about that, assignment is the flip side of the coin to exercise. So if I'm a buyer of a contract and it's American style, I can exercise that contract at any time for any reason. There are certain times when it may be more prevalent to exercise early, typically around a dividend event, but that's something, for a later session. But as a seller of an equity or ETF, I've got that risk of receiving an assignment notice at any time. If it's a European style contract, so that would be an index or the majority of indices, then I don't have that risk. It's not something I need to worry about. Again, one of the reasons that a lot of these big institutional firms trade the indices versus individual stocks. So thank you for that question. Let's go ahead. Another polling question here. And this, again, the price at which a right or obligation to buy or sell stock is commonly referred to as the what? The strike price, the buy-in, sell-out price, the aggregate value price, or the enter-exit price. We just talked about this. Let's see. Hopefully you understood what I was covering just a moment ago. The price at which we have the right or obligation to buy or sell stock is commonly referred to what? Go ahead and choose that again on your screen. A, B, C, or D, the strike price, the buy-in, sell out, the aggregate value, or the enter-exit. What do you think? And while you're looking at that, there's another question that I see that just came in. Ricardo is asking, the 60 million a day, is that just in the US or around the world?